Hi, I'm Mark from Property Ventures. Welcome to this week's New Zealand Property Podcast, where we interview the property expert around New Zealand.
Hi, I'm Mark Honeybone from Property Ventures, and today we have the first part of a two-part series with John Bolton from Squirrel Mortgages. He is a very successful investor in his own rights and has helped many of my clients. In the first part of this podcast, John will talk about the latest OCR and what it means and where he sees it going in the future. Then he talks about why mortgage brokers and how they can help. We're sure you'll enjoy the show. We have spoken to several professionals so far in this podcast series that you'd want on your team. Well, today's has to be one of the most important. As they say, money talks, or in the property investment game, money or leverage of other people's money, usually the banks, is the only thing that can keep you moving forward after a while. So getting access to this money is most important. So to talk about this and much, much more, welcome to John Bolton.
Hi, thanks Mark for having me.
Pleasure. Just a quick introduction on your background and how Squirrel Mortgages come about so listeners know who they're listening to today.
Yeah, sure. So I guess I have a banking background. I spent about 12 years at Westpac and ANZ. My last role there was as general manager of products for the entire bank. So in that role, I guess I was responsible for deposits, mortgages, pricing, revenue, pretty much the whole gambit in terms of a retail bank. But, you know, I had enough time in the bank and was feeling that I wanted to try something else. So in 2008, we pretty much set up Squirrel, launched into the market just as the GFC was hitting, which was possibly the worst time possible to launch a business.
Yep.
And you know, it was like jumping into a pot of hot water, really. The first couple of years, you know, I'd come out of a head office, so I wasn't used to dealing with, you know, I guess, you know, people out in the real world. I didn't have any networks or contacts, so I launched the business on day one with probably 3 or 4 staff. So I had high overheads, high expenses, no customers in a market that was crashing. It would be fair to say the first 2 years was was pretty tight, and there were stages there where, you know, I got pretty close to running out of money. So, you know, I know how it feels when you're starting out a business and how tough it can be, especially when the market's tough.
Absolutely. You know, as they say, you know, those who have hard times usually come out the other end stronger and better for it. So, and you've obviously had that in 2008 when you started.
Got quite a few scars.
All good, which makes you stronger for the future, which is all good for your customers, I guess. So tell us a little about what Squirrel does, who you cater for, and who would be your usual customer, which I think there might be several, but...
Okay, well, we started probably the business in 2008 focused on first home buyers. That was a naturally good market for us. Over time, I guess, certainly given my experience and background, we tended to end up with a lot more investors starting to come through. More recently, we've diversified the business to pick up the Chinese and Indian markets. So we've got a team dedicated to Chinese buyers here in Auckland and a team based out of a second branch in Manukau that focuses on the Indian market.
Great. Well, that's pretty good, and we'll actually speak a little bit about that later on. One thing that's obviously very topical at the moment, latest OCR increase happened just yesterday. So what I'd like to be get your take on it, and how you think it might affect investors, if it will, and who else it might affect at this stage.
Okay, we'll be prepared for quite a long rant now.
Well, it's very topical, and I'm sure people love to hear what you've got to say.
Okay, so I think the first thing is that it does come from a point of view that's reasonably well informed. So whilst I'm a mortgage broker, obviously with my background, I've got a pretty good understanding of how this all works. The way I see it at the moment, we seem to probably have a better feel for the market than probably even the bank economists and possibly the RBNZ, in the sense that we're talking to people every day, we're seeing what's happening on the ground. And it generally takes 2 or 3 months for that to sort of start to pass through to official statistics that then sort of give a more market-orientated information. So my feeling at the moment is that the market's slowing down a lot faster than I guess certainly the commentators in the market have been talking about. It's been slowing down probably since before Christmas. I think the market really started to turn in November last year. You're only really seeing the impact of that now. So house sale volumes are down. There's certainly a lot less people out there buying, and there's a bit of softness coming through in the pricing now. Now, from an investment perspective, I think that's a good thing. I think that last year, particularly the Auckland market, was completely mental. Things were going for ridiculous prices. People weren't buying on fundamentals. Yields were low. It was crazy times. So the fact that there's a bit more sensibility in the market, I think, is actually a really good thing. It has slowed down a lot. The more interesting thing for me recently has been, because I'm also in property development, probably 6 months ago, all of our builders and tradies were almost euphoric with the amount of work that was coming through the pipeline, and we were struggling to get tradies. Their prices were going up. Everyone was booked up 6 to 12 months in advance. We're just starting to see that shift at the moment. I think it's not as busy as you think out there, and there's certainly we're seeing more builders and more tradies that have actually got a bit of spare capacity coming through. And what's driving that, I think, is that Kiwis are actually a bit more conservative now. We're seeing, and of course, construction costs have gone up, and that's probably the big thing. Is people are surprised about how expensive it is to actually renovate, property.
Yep.
And we're not talking the sort of property trader spending 20 or 30K putting a lick of paint and some carpet in a place. I'm talking about people that are, doing a major renovation on their family home. And, we're seeing plenty of examples where people are going into that process assuming it's going to cost them, maybe 200 or 300. And then when they're getting it priced up, it's coming back at 500 or 600. And are staggered by that. They're surprised. It's a very big investment. And that's happening in an environment where interest rates are going up. We have an election, and we're sort of starting to get the odd negative headline around property. So I don't think people are as confident as you might sort of, feel when you look at some of the market-based sort of commentary around, confidence and stuff. And I think it's pretty shallow. And, these increases in the OCR that we've had, I think are having a faster impact in terms of people's confidence in the market than perhaps it has in previous cycles.
Right. Yep.
So look, what that means with the OCR is that the Reserve Bank signalled that, there's at least another close to 2% priced in over the next 18 months. That takes the OCR up to about 4.75, maybe 5%. What we've got to remember is that by historic standards, that is incredibly low. In fact, in the last 40 odd years, the only other time that rates got that low was during the Asian crisis, where the OCR got as low as, I think, 4.75. Now, that's as high as they're talking about it going in the next year and a half. And so in a year and a half's time, once it's increased another 1.75%, it will still be at a historical low point. And as I say, the last time it was that low was during the Asian crisis. Now, the interesting thing is when the OCR was last time around, when it was 4.75, the 2-year fixed housing rate was 5.95%, which is what it is today. So although the OCR was 1.75% above where it is today, the actual 2-year housing rate was the same as it is today. And look, that's where I think there's a lot of misinformation out there. At the moment, everyone seems to sort of go, if the OCR goes up 2%, mortgage rates will go up 2%. Therefore, in a year and a half's time, we're going to have interest rates of 7.5% to 8%. And that's bollocks. Basically, in a year and a half's time, your fixed rate mortgage rates will not be that different from where they are today. And this is this is one of the points that you do hear sort of come out in market-based commentaries a little bit, which is that all these sort of increases in the OCR are actually already priced into the fixed rates.
Right. Yep.
So, in all honesty, I wouldn't expect to see fixed rates move that much. The caveat on that is that we do get a bit of panic set in. So Kiwis are notorious for panicking about interest rates. It seems to be a national pastime. Around OCR changes, we do see a bit of a rush of people out to fix. And if lots of people go out and fix at the same time, the market can't cope with that, and that will naturally drive interest rates up for a little while.
Yeah.
But generally what you sort of see is as the market settles down, those rates will come off again. So, your listeners might see interest rates go up in the next sort of, 4 to 6 weeks. They may or may not. If they do go up, that's certainly not an indication the rates are going to continue to go up. That will be more as a response to the amount of fixing that's actually occurring at the moment.
Yeah, interesting. My wife sort of watched the news last night. Typical Kiwi lady, I guess she is, and saying, Mark, you better fix some more of these mortgages we have. And I said, no, at the moment we've got some fixed for 2 years or so, previously, and the ones at the moment I'm floating, I'm more than happy to do. For fact, exactly the reasoning you've been saying, which is quite nice for me to hear you say that. But I totally agree. Kiwis do panic a little bit when they hear the OCR's gone up 0.25, and as you said, I know it's way below what the average has been, the average for New Zealand is, and as I said, when it goes up 2%, not necessarily the housing mortgages might not go up that 2%, and hopefully they obviously won't.
Yeah. Well, I mean, that's the whole point, is that the OCR is going to increase to let's say 5%. Whoopee.
yeah, that's right. I mean 2.5%. I mean 0.25 if.
The OCR has been as high as 8 or 8.5. It's certainly not. It's not high, and it's not going to be high in the next couple of years. And yet, when you sort of, I guess, when interest rates start going up, we sort of start to think back about sort of 2006, 2007, where, we saw mortgage rates getting up to 8 or 9%.
Yeah, just on that point, when they back in those years when they were at sort of 8 and 9%, and in fact I had one very briefly with a second tier at 10%, I think, but when they were at that sort of rate, what was the OCR at that stage? Do you remember putting on the spot here?
I think it was around 8.5%.
Okay, yeah.
So it was certainly up at that sort of level.
Yeah, and as you said, and that's something I've certainly noticed in the last couple of years when the commentators say all sorts of different things, but when the best time this seems to be to fix is before the commentators are talking about it, or even after, as you said, after the OCR has gone up after a wee while, because things do calm down a little bit again afterwards.
Yeah, look, the way to think about your mortgage is, how much certainty you actually need versus just trying to pick the lowest cost trajectory for your mortgage. And I calculate implied forward rate, so I actually work out, using different fixed rate terms, what the interest cost will be over time, and we've actually got a calculator that does that for us. And I guess what that sort of shows is how far interest rates have to increase to be better off fixing for a longer term rate. And I think at the moment, anything beyond a 3-year fixed rate is really priced out of the market. You'd actually need interest rates going up to 8% in the next sort of couple of years for that to be worthwhile. I just don't see that happening, based on everything else that we've been talking about.
Yeah, no, that's right, and everyone has a different circumstances for why they want to do things, and that's the other thing some people forget about. If they do a 5-year fixed loan, what are they missing out on in the first 2 or 3 years, as you just mentioned? I heard one expert yesterday, so-called experts say that they reckon next around it might go up again, and then it might stay stagnant for a while to see how the market goes. What's your prediction in the next couple of announcements?
Well, I think the Reserve Bank doesn't want to sort of change its tune quickly. So, it's all about consistency. So I think you saw that with the OCR yesterday, as it was a very, very consistent message to the last one that they had.
Yes.
I think they will be keen to get another rate increase through with a fairly consistent message. But after that next rate increase, I think they'll take a bit of a break, take a breather. I think that the problem that the Reserve Bank's got, just like just about anything in New Zealand, is information slow and not overly reliable in this country. So I think they'll probably want to get another rate increase through, but then take a bit of a break and just see how that's flowing through into the real economy. If what I'm seeing at the moment with a real slowdown in the housing market and, a bit of spare capacity coming back into the construction sector, particularly in Auckland, a lot of stalled construction projects at the moment because the cost to build so high. If those sort of things continue and we continue to have a high dollar, and maybe a bit of softness coming through in those sort of record level commodity prices, then you might actually see the Reserve Bank take the foot off the gas a bit, and slow down any subsequent rate increases. But the reality is, I think everyone should still be planning on an OCR getting towards 5%, because that's probably sort of rate neutral.
Right. Yep. Okay, well that's great. Hey, thanks very much for the insight on that, and hopefully we'll have this out to the listeners within the next 24 hours, so it's still extremely topical. So that's great. Okay, we've talking to you primarily because you're a mortgage broker and you're out there and doing it. A lot of our listeners are really from new investors about to start to the very experienced investor. So probably the next three are more for the newer investor. So can you tell us why a broker over dealing directly with a bank?
Well, not all brokers are created equal. I guess the thing with brokers is that a lot of brokers are actually property investors themselves.
Yep.
So they kind of get the game, and they do it themselves. So you're getting good holistic advice with. Depending on what part of a bank you're dealing with as well. If you're in business banking, it's a slightly different experience to if you're dealing in retail. Often, if you're in the retail bank, you're dealing with people that don't even necessarily have their own properties. You get a lot of turnover in the banks as well. I mean, that's probably one of the biggest criticisms that we have, is that if your relationship manager changes every year and a half, they never really know you properly.
Yeah, that's a big problem. Yep.
And that seems to be one of the big problems, is that you're constantly reinventing the wheel and having to sort of explain things again and again, and having to wait for the bank to kind of catch up, because it's a bit like a goldfish. You sort of goes around the tank a few times and it forgets all the conversations that you've had with them previously.
Mm-hmm.
Mortgage brokers provide, I guess, consistency. You build up a proper relationship, that can last a lifetime, and you don't have to repeat all those conversations again and again and again. But probably the biggest thing, and it sort of fits in with that whole relationship side of it, is that we're often planning with clients quite far out. So we're not just talking. So we don't just sit there and go, okay, right, you need a mortgage. Let's go out, get you a mortgage, and here's an interest rate, and off you go. Good luck. Often our conversations are, okay, well, where are you at the moment? Where do you want to go? What's your strategy? Okay, so you want to buy a property each year. Here are the key issues for you. Maybe your income's a bit low, so you need higher yielding properties, or maybe you don't have a lot of equity, so we need to find a way of recycling deposits, or maybe a combination of both. But we can actually we can round out their property strategy with a strategy to make sure that they can get finance, not just now, but in a year's time, or 2 years' time, or 3 years' time.
Yep.
And it's pretty much, I think that's where the real value is.
Absolutely, and that's one of the things I talk about. People ring me up, and I can't give advice. I'm not a financial advisor or anything like that as such. But what I say is, you think ahead of when you're buying a property. If you want to move ahead and buy more, you have to buy your first one. It has to have equity in, so you can, or be able to create equity so you can get your next one. Especially if they haven't got much of a deposit, but you obviously go further into that, and their background of what they do have and what they're trying to achieve also. So that's very important.
Yeah, yeah, and look, I mean, a lot of the time, so we've got a lot of good clients that we've ended up helping a lot. You can't help everyone, and sometimes people are perhaps a little bit too ambitious
Yep.
for the resources that they have. And maybe a little too impatient.
Yep, there's a good few of them.
Yeah,
Who's
it's
not impatient?
yeah, impatience is something we bump into a fair bit.
Yeah.
I want to get rich tomorrow, but I think property investing is actually quite a long game. Most of the really successful investors that I see aren't the ones that try and become millionaires overnight. They're the ones that just methodically get about their business, and they take years.
Yeah.
Like years and years and years, but they certainly get there.
All you have to do is go to a property investor association meeting and see a few of the older people in the room and see how they've done it, and they've done exactly as you've just said.
Yeah, yeah. So it's a slow game, and
Yeah.
if you try and play it too fast, invariably you'll fall over at some point.
Yep. Yeah, I can vouch for myself. One impatience, or one property deal about 8 years ago, and don't rush into things. All my advice will be on that one. Okay,
Yeah.
so you've probably covered this a little bit. So when you actually look for a broker, you're going to decide, hey, I'm going to get a broker because I want that relationship thing rather than being a number with a bank. How do what do you look for? Obviously, you've already mentioned that brokers that are investors are sort of have a bit of understanding with the game. So what else would you look for?
Yeah, I mean, I'd look for brokers that have probably been in the finance industry for quite a while, and also brokers that have actually got property investing experience themselves, and are pretty passionate about property. You want people that are as excited about property investing as you are, but at the same time have really good financial skills. There's a lot of brokers, there's a lot of people out there that sort of, I think, come and go in terms of being a broker, because it kind of fits well with being a property investor. So they're an investor first and a broker second. I'm not so keen on that. Because I don't think you necessarily get the best financial advice.
Right.
I think you actually need someone that really knows what they're doing, knows the ins and outs of the entire market, and has got solutions pretty much for everything. But at the same time, is passionate about property.
Yep. Great work. Okay. Well, for a new investor out there that hasn't yet started but they want to, what should they do to get ready?
Well, I think that first property is actually probably the most important. One of the things that I say to a lot of clients, I mean, look, most clients generally their first property is actually owner occupied, and then they sort of start doing investment property after that. But we do get the odd one where, because of property prices, they jump straight to investment property first. My advice generally is that the first property is the most important. And the reason for that is that, particularly for getting capital growth, the problem that most people struggle with is getting deposit funds.
Yeah.
It doesn't take a huge amount of income to provide servicing for at least 2 or 3 properties. And so typically the issues around deposits, and that whole deposit thing's got a lot tougher with the LVR restrictions. So whilst in the past, people could borrow up to 5 properties at 90%, you just can't do that these days. You've got to have, if you don't have 20% deposits, you've got to probably have at least 15% equity in the properties. And I don't think that's going to change in a hurry. And so, so that's probably slowed down younger investors a lot, and that it's become a lot harder to get the equity to continue. So equity growth is the critical thing. So often what I'm sort of saying to investors now is that you actually need to find a project. It can't simply be a passive investment. You need to be buying probably about 15% below market value.
Yep.
And you need to be sort of buying properties where not only can you get that 15%, but there's a bit of a twist to it that you can get some more capital growth, whether that's adding a bedroom, to get your yield up, which then translates through to the value, or it's subdividing, putting another house on the back, creating a minor dwelling. There's lots of different ways that you can do it, but you really need to be focused on creating equity so you can then leverage that into the next property.
Absolutely. And if they have trouble finding it themselves, of course they can find a good property finder service, of course, to do that, I guess. But that is so important. As you say, the first property is, especially investment property, is so important for them to moving ahead. Just on that, you're saying about the 15% below market value. I've come across just a couple recently. Have you seen many deals lately where the vendor is prepared to leave finance in? So has the client gone to you and said, hey, the vendor's prepared to leave 10% in here? If that's the case, how does that help with the situation?
Look, it's a little bit tough. Banks won't really look at that, but your second tier lenders, your non-banks, will.
Right. Yeah.
So there is an opportunity to do that sort of thing with your non-banks. There was a lot of that went on in the mid 2000s. And it got pretty loose there for a while, but it's certainly changed, and it's not like that anymore. It's pretty tough dealing with vendor equity situations, but it is doable. Where we tend to see it a lot is not so much with residential investors, and we see it a lot more with commercial property, and we see it a lot more with agri. So it's quite common with farms. For farmers to leave some vendor financing in because of the amount of deposit and equity required to buy these things.
Okay, yeah, I know the bank seem to have a bit of hurt in there from the purchaser.
Absolutely.
Yeah. I just had one last night again. Someone couldn't get the deposit up, and so my vendor said, "Well, would they be willing to, if I left 10% or more in?" We haven't even talked about a figure yet. So again, it's a conversation you have, I guess, and then you see what pans out and talk to your broker, and then we decide where it can go from there.
Yeah, absolutely. But it's completely doable. Your second tier lenders, your Resimax and your Liberties, tend to take a fairly pragmatic view on these things.
Right. I'll talk about that shortly, actually. But so just moving forward, I see a few deals falling through because of finance. You obviously see a few, more than me. To save time for the investor, what sorts of things should they look out for or have prepared before even coming to you and asking for finance?
Okay, well, probably, the biggest issues we see that can potentially impact on finance sort of multi-income properties. And things like leasehold and stuff, and non-standard apartments. Those would be probably so basically bank credit policy. The first thing is that when there's more than 3 incomes coming off a property, it is pretty much across all of the banks considered non-standard. Now there are some exceptions to this rule. I've managed to get 80% funding on property with 6 incomes. So particularly with some of the smaller banks that we deal with, they tend to be a bit more flexible around these sort of properties. But amongst the big banks, rule of thumb, if it's got more than 3 incomes, it's considered non-standard. If an apartment is less than 50 square metres, it's generally considered non-standard. And leasehold properties and properties that are under some sort of hotel management pool, they're all considered non-standard as well. What a non-standard property is it's a residential property with some sort of uniqueness about it that means it's hard to sell in the market.
Right.
When the market's soft. So, multi-income properties where it's more than 3 incomes, tiny bolt hole apartments and leasehold property typically are difficult to sell when the market is in bad shape. And so the banks, hard to sell properties, the banks sort of label as non-standard. Basically, they discount the value of the security, and they'll only generally lend up to about 65% on them.
That's where we will leave the first part of this podcast. Please listen to the next, where we will continue to discuss about working with a mortgage broker and learn a bit about investing from a master. If you have any suggestions on who you would like to hear on one of our podcasts, you can contact us at propertyventures.co.nz. Thanks for listening and have an awesome day.